Hi, and welcome to Hedge Fund Manager. I'm Karl-Mikael Siding. Today we're doing a deep dive into Meta platforms, formerly known as Facebook. So let's start with the screening. I'm going to do a bit of a comparison with a couple of the Magnificent Seven, the large US tech stocks. So what I do first is a FinViz screener, where I simply put in a filter for the top 15 mega caps. So here is FinViz, and what I've done is that I've chosen the mega caps, so all companies with more than $200 billion in market cap, and then I've sorted these on gross margin and on profit margin to see which ones are the most profitable. That could be an interesting way to find good, interesting stocks to analyze. In FinViz, you can also sort these companies, the mega caps of more than $200 billion, according to, for example, lowest PE. What we can see here is that we find the bank JP Morgan at 12, Google at 18. So Google is possibly the cheapest of the Magnificent Seven. And never mind Berkshire. And then we have TSMC and Meta at 23. Actually, that too stands out as surprisingly cheap given what type of a company it is. And among the highest PE ratios, we find Tesla at 152 times last year's earnings, and Broadcom at 91, Pharma, Eli Lilly at 76, and then a couple of others, including Walmart and Nvidia, then Amazon and Apple, and Microsoft, all close to 35 times earnings. So that would be pretty expensive unless we have reason to believe that the growth will be really, really strong. As a complementary filtering, I look at price sales, and the highest one is Nvidia at 20, and the pharma company Eli Lilly at 18. The lowest price sales is Walmart at 1.1, and what we should realize here is that if Nvidia can have 20 times sales in valuation and Walmart can have just 1 time, there is something we need to understand about price sales as a valuation ratio. And the reason what we're really after is, of course, earnings and future earnings and the sum of future cash flows and earnings. So that has all to do with earnings and cash flows. Sales is just a way to get to the earnings, and Nvidia has remarkably high margins. That's why it also can have a really, really high price sales ratio, and whereas Walmart has incredibly thin margins. Then in the ranking of lowest price sales, we have JP Morgan again with just 2 times sales, and then Amazon at 3 times sales. That also seems remarkably cheap compared to Nvidia's 20 times. But again, Amazon is a retailer so far with also pretty thin margins. But there is some kind of expectation that they might get much higher margins in the future. That's why Amazon has always been very, very highly valued in terms of price earnings ratios. And then we have Google or Alphabet at 5 times sales, which in a way seems reasonable in this group of companies. Remember, Nvidia at 20 times is more than 4 times as highly valued in terms of sales. And they should have about the same kind of margin potential, I would say. They are both software companies. Not dependent on huge manufacturing capacity or huge real asset investments. Moving on to the highest past 5 years EPS growth, so earnings per share growth. Remember that you can't just look at earnings growth, it has to be earnings per share growth, because some companies issue a lot of stock, not least in terms of options instead of salaries for their personnel, and some companies buy back a lot of shares. So in terms of highest EPS growth the last 5 years, we have again Nvidia at 92% EPS growth per year for 5 years, Amazon at 37% and Meta at 30%. The lowest are, not surprisingly, well, never mind Berkshire at 4%, but also Walmart at 7% and JP Morgan, the bank, at 13%. Apple is actually just at 15%, which make it pretty surprising that they are as expensive as they are, since they are not really a typical growth company. So it has more to do with the aura around the company. And I also like to include in my screening 3-year performance and ranking on 3-year performance for the stock. We have Nvidia at the top at 500%, Netflix also close to 500%, and Meta is in this respect lagging pretty badly at just 170% over 3 years. The next thing to check, I think, is also 1 month performance, because if the 1 month performance is weak, that could be a buying opportunity in case we have a quality company that is cheap and has a strong 3-year performance. It could also be some problem brewing starting to take hold. In any way, among the 1 month poor performance, we have Meta at the top, followed by Apple and Amazon. Netflix is at the other end of the scale with an 18% rise over the last month. Right now, I don't really see any strong headwind or tailwind in terms of the stock price performance. Maybe I would say that Meta is possibly indicating a buying opportunity from their pretty strong 3 years and then just a 1 month temporary setback. And I've also just included a price earnings ranking for the companies we're discussing, the Magnificent Seven or Eight, the Batman companies, including Broadcom. I've ranked them from low to high, with Alphabet at just 18 times, so Goog, short name, and then Meta at 22 times, and then there is a gap to Microsoft at 31, Apple 33, and then finally Tesla around 150. A low price earnings ratio could indicate it's cheap, but it could also be kind of a value trap that the market has started to anticipate worse growth or worse profitability ahead. So what we will check in today's deep dive is which one is actually cheaper. Is it Alphabet or Meta? And what about Nvidia? So it all actually depends on the likely EPS growth for the coming years. And remember, what we're really looking for is a company that pretty soon will cross below a price earnings ratio of 10 on future profits, and as soon as possible cross below 10 times that year's earnings. That is typically indicative of a good, attractive and good prospective returns type of investment.